Hello friends, welcome you all to the next lecture of the JCE eConnect series of online lectures. In previous lecture, we have discussed about the concepts of balance sheets and income statement. Carrying that thing forward, today we are going to discuss about financial ratios. So let's start with the introduction. What are financial ratios? Financial ratios are the ratios used to evaluate the financial status of the company. These ratios provide information about the company's ability to meet the financial obligations, profitability, liquidity, and effective use of its assets. Financial ratios represents the relationship between the financial data shown on the financial statements. These ratios are calculated by dividing a category of financial data by another category shown on the financial statement and are then compared with other companies within the industry. So now when we studied balance sheet concept, okay, we also termed that balance sheet gives us an indication of financial status of the company. But balance sheet is a detailed description. It has many entities which are entered and final value we get it, from which we have to establish a judgment. But these financial ratios are clear cut definition of the position of the company with respect to its finance. For example, say your mark sheet. Mark sheet will show subject wise marks, but overall what is given importance? The SGP or CGP value. So similarly we can say here that the financial ratios are the CGP values, or in similar to that, which will directly give you the indication of the company's performance. Okay, so financial ratio is a simplified way of judging a company. Now many times when we see news, we see that the profit and loss of a company, especially it is published quarter wise, that is after every 4 months. So how are these profits or loss indicated in terms of percentages? So what are these percentages? Indirectly they are the financial ratios itself. Okay, so once you study financial ratios and understand these ratios, it will be easy for you all to judge a status of a company, or if you start your own company, or if you are working for a project in a company, with respect to that work which is there in your hand, you can develop these financial ratios to ascertain whether you are going in the right financial progress or no, or it even gives us an indication what corrections need to be done. So today we will discuss about 6 important financial ratios. First one to start with is current ratio. So what is a current ratio? Current ratio indicates the ability of a company to meet the short-term financial obligations. In other words, it is a measurement of company's ability to pay the current liabilities using the current assets. See here the terms current liabilities and current assets are directly derived from your balance sheet. Okay, so what does current ratio indicate? It indicates whether the company is capable of paying the current dues. Okay, and payment of this current dues depends on the current assets and current liabilities. The relation for current ratio is given by, directly it is the current assets divided by current liabilities. Okay, so now if your current assets, hopefully you can recall the definition of current assets. These are those assets which can be converted into hard cash or liquid form, what we say in financial terms, within a year are termed as current assets. Current liabilities are those liabilities which have to be satisfied within the short period of time. Okay, so now it has to be clear that what should be your value of current ratio. If your current ratio is say greater than 1, less than 1, okay, what will be the scenario of the company? Because current assets have to be greater than current liabilities, else your company is not performing well and day-to-day needs cannot be met. So therefore, when we go for the further discussion, these points will come up. Current assets and current liabilities shown on the balance sheet are used in this calculation. This ratio gives about the information about the working capital status of the company. If the current ratio is less than 1, it indicates that current assets of the company are not sufficient to satisfy its current liabilities, whereas a greater value of current ratio is a strong indicator of the ability of the company to pay its current liabilities. Means it is sure that your current ratio should be greater than 1. So once your current ratio is greater than 1, you can satisfactorily say that the current liabilities of the company can be easily satisfied. But the next point to be considered here is, if we have a very high value of current assets, say current assets value is far greater than 1, what does that indicate? So if in one term, without economic knowledge, you feel that you have bulk of current assets and that's a very good situation. But on the other hand, it can also conclude that okay, your assets or the company assets are tied up in current assets and are not invested, they are not making any profit. Simply you have invested in the form of current assets and it is not yielding you anything. For example, if you purchase more than required number of vehicles, okay, so what happens? You have to maintain the vehicles, but at a time you can use only one vehicle, right? So as a backup, having a second vehicle is fine. But say if your company invests in more number of vehicles than required and if they are not frequently used, then that investment which was the current asset converts itself into current liabilities, because even if the vehicles are not used, they have to be maintained. Here on paper you have high current assets because you can sell that vehicle and encash them in a short time, but are those current assets investments valid? Are those giving you all profit? These are the questions to be asked. Okay, so in this case, the role of the financial manager or a role of an engineer who is dealing with the financial aspects becomes very important. So you have to invest in those current assets which are fruitful. As you have funds, it doesn't mean that you have to increase your current assets, because the current assets, if kept without use, can become current liabilities also. Okay, now as the lockdown was there, many of us who are having ungeared vehicle, right, we did not take care of our vehicle properly. Now once the lockdown was relaxed, we went to start our vehicle, but it was very much difficult to start our vehicle. We had to repair or service our vehicle. Okay, that time what happened? Because of the current asset which was kept unused, it developed one current liability. And if that would have kept, if you would have kept our vehicle like that only for few more days, maintenance cost would have gone increasing, right? So this is where the balance of current assets and current liabilities comes into importance. Okay, so as a construction manager, you should be aware that this ratio doesn't go far beyond 1. If the ratio is far beyond 1, you should do the analysis and see where your current assets are stuck. Okay, you have to retrieve those current assets and invest with the view of making profit for the company. So this is about your current ratio. Then next is quick ratio or acid test ratio. Quick ratio measures the ability of a company to pay current liabilities using cash or other assets that can be readily converted into cash. It is given by cash plus accounts receivable divided by current liabilities. So now it is a similar version of your previous ratio, that is the current ratio, but it is quick or acid. Why is the name given quick? It defines the ability of the company to satisfy its liabilities then and there with cash payments. Okay, if you have a due to be cleared, at that moment if you are able to pay it in the cash or give the check and finish off the due at that moment, it shows that your company has a good quick ratio or asset test ratio. Now here, current assets can be many in number, but can all those be converted into cash immediately? As discussed previously, it is difficult. Okay, so what is the quick ratio? It is the immediate ability of a company to satisfy the dues. Now, why is this important? Say, any accident happens on the site and that labor is admitted to a hospital, and as a construction manager or from the company, you have to pay the bills. Now, even if your company is big, you cannot tell in the hospital that my company is big, so give the treatment, I will pay it later. No, that service has to be, that cash or that bills have to be satisfied at that moment only. So in that case, you may be having a lot many assets, but are you able to satisfy the current urgent requirement? If yes, it's appreciable as you have taken care of your quick ratio or asset test ratio. If no, then you have to think over it, because many times this quick ratio or asset test ratio gives the cushion in case of emergencies. Okay, in case of uncertainties or in case of accident, this ratio becomes very important to analyze, okay, the company status. So understand the importance of any ratio and then try to study it, it will be easy. So it is given by cash plus accounts receivable divided by current liabilities. It is a measure of the short term liquidity of a firm and provides information about its immediate financial status. This ratio is calculated by dividing quick assets category of current assets of a firm by its current liabilities. The quick assets include cash or accounts receivable. What do you mean by account receivable is just you are supposed to get money from someone and you have to pay it to some other party. So if urgent situation comes, you should be able to recover that receivables within a short time and pay to that other party. Okay, that is accounts receivable. So always remember, in civil industry this quick ratio is very important. Second example if I want to give here is, you are operating a machine and suddenly some part of that machine gets damaged, or because of some technical reasons the functioning of the machine stops. It requires urgent maintenance, but that you have not quoted in your budget. Okay, so work stops. Can you afford it? No, your further other budget will get collapsed. Then at that time you should have sufficient funds with you such that the maintenance work, which can be costly in case of highly sophisticated machines, should be done, and your work should restart at the earliest. Okay, so at that time which funds you will be using, or how can you gauge whether you are capable of doing that emergency work or no? It is the quick ratio or asset ratio which will give you that judgment. Okay. Next, inventories and retentions receivable of account receivables are excluded from quick assets because these assets cannot be converted into cash quickly. Now, inventories and retentions. Okay, so you have invested in a factory, you have invested in material, okay, you have invested in big machinery. They are your assets or current assets, but they are not taken into account while calculating quick ratio, as immediately they cannot be converted into cash. Okay, so you need to take care of these points also, the factors which can be immediately converted into cash and those assets which cannot be immediately converted into cash. So while calculating quick ratio, you have to only use those parameters which can be immediately converted into cash. And that's why even if you look into the market, if you want money immediately, yes, you will get it, but you have to pay a higher rate of interest. That's why the analysis of quick ratio or asset ratio is very important, especially in our industry. A quick ratio equal to or greater than 1 indicates the ability of a firm to pay the current liabilities with the quick assets. If the quick ratio is less than 1, that means the firm needs to convert some inventories or other assets into cash for payments of current liabilities under emergency conditions. Okay, so that is important. So if your company has a quick ratio less than 1, in a short period of time you have to plan and see that the assets which are of not that great relevant importance are liquidated and your quick ratio is brought above 1, so that current liabilities under emergency can be satisfied very much easily. It doesn't mean that you keep a lot of cash with you, because again it is also not right from business point of view. Now this thing you also must be experiencing if you are going to a canteen and if you remove a 100 rupees note, all your friends, other friends who have also had something with you in the canteen, they just move away because you have a 100 rupees note and you are paying it, and all the bill will be satisfied by that. It's sometimes a negative thing keeping more cash. Okay, so you might recall someone's name and have a laugh over it. Okay, that is what happens when you have more current assets than required at a point of time. So if you remove a 10 rupees note, automatically someone else will also come and remove one 10 rupee note and others will join. Okay, that's how you have to manage your current assets, and that's why you require to give importance to these first two ratios. Next is debt to worth ratio. This ratio is calculated by dividing total liabilities of a company to its net worth or owner's equity. It is also referred to as debt to equity ratio. Okay, so now it is given by total liabilities upon net worth. Okay, so total liabilities is a term which indicates all the possible payments which a company has to make. Okay, all the possible payments which the company has to make are indicated in total liabilities. Those are not only the current liabilities or which have to be paid currently or in a short time. All the entire loans which are there on the company's name, okay, or any other things, or anywhere if the company has borrowed some amount from investors, all those comes under total liabilities. And net worth of a company is taking all the assets into consideration. Okay, so if your total liabilities can be satisfied by your net worth, okay, you are doing things in a right way. But if this is not done, then these are the cases like Vijay Mallya or Nirav Modi, and many other examples are there where the debt to worth ratio went like anything. Okay, so if you are taking loans, you have a viewpoint that you will have the assets to repay it. This ratio is a measurement of company's leverage, and the desired value of the ratio should be less than or equal to 2. Now see here, okay, taking the factor of safety into consideration, we are keeping this ratio high, we are not keeping it 1, because if it falls below 1, your company goes. Okay, then so that's why this ratio, debt to worth ratio, is kept a bit higher. If debt to worth ratio is less than 1, it indicates that firm is not utilizing the debt in the business to increase the return on the investment. Further, a lower value of the ratio indicates that there is more protection to the creditors, as the owners of the firm are contributing majority of the funds to the business of the firm. A debt to worth ratio of greater than 2 may result in a greater risk of repayment of debt along with interest during recession in the construction industry. Okay, So now this ratio gives you a clear idea how are you utilizing the investor's money. Are you utilizing the investor's money in a proper way or no? Or is the owner himself putting more and more money? Okay, if the investor's money is not properly used, then why to take money from them? If the owner's money is only completely utilized, then he can be at risk because all his funds might get exhausted. So it gives you an indication how are you investing the money which you have got from the investors or taken as loans from the bank, okay, and how well you are managing the profits. Okay, so basic rule is what? Invest more, invest properly, get more profits. Invest conservatively, get less profits. So only this ratio has been kept as 2. So going beyond that, repayment becomes difficult. Okay, so you have a cushion. Sometimes you get some time, extra time, or you get some rebates or some benefits on the loan. That's why we can keep this ratio as 2, but never allow this ratio to go beyond 2. If it is less than 2, then you are on the conservative side. If it is beyond 2, you are on the risky side. Return on assets ratio. The return on asset ratio is calculated by dividing the net profit after taxes by total assets of the company. This ratio is expressed as percentage and is given by net profit after taxes upon total assets. The net profit after taxes comes from income statement, and the total assets we take from the balance sheet and are used to calculate this ratio. Return on assets ratio measures how efficiently a company uses its assets to earn the returns and indicate profitability of a company. For a company, the effective use of assets earns a higher return, higher value of this ratio, whereas there is low return on assets if the value of this ratio is lesser. Okay, so now this is an indicative ratio of the management. How is the company performing? If this ratio is bigger, that means you are getting most things done out of your investment. Okay, that's the principal rule. Now this, if you see a person removing sugarcane juice, okay, he doesn't put that sugarcane only once inside the machine. He puts it once, twice, thrice. After that he again folds that sugarcane which is already completely exhausted, but he extracts up to the last drop. What is that? Complete extraction of your profit from your investment. He doesn't leave it there. Okay, so that's what's the thing to be learned. Practically all the private managements do the same thing. They want employees to work and work and work as they are investing on them with the view of increasing profit. And in business everything is fair, because what matters is money and profit, and this ratio gives you an exact indication of this. Now if this ratio of your company is less, or say of your unit of which you are in charge is less, or say of your project which you are handling is less, you may be questioned by the company. Okay, so that's where your labor management skills, material management skills come into importance. Nextly, the return on sales ratio. This ratio is calculated by dividing the net profit after taxes by net sales revenue. Return on sales ratio is expressed as a percentage and is given by net profit after taxes upon net sales revenue. The operating revenues, that is the net sales, and the net profit are taken from the income statements and used to calculate this ratio. This ratio indicates the profit margin for a company and measures how efficiently a company can meet the adverse market conditions such as decline in demand, falling in prices and increase in the costs. An increased value of this ratio indicates higher profit. Similarly, a lower value indicates a reduction in profit margins. Okay, so now this ratio is very important because it is directly connecting your profit with the sale. More the sale, more the profit, but more will be the use of current assets. So balancing here becomes very important. Okay, study of the market demand supply analysis becomes very much important in case of this ratio. If the demand is high and you overproduce without analyzing a market, you have full of stock and suddenly the market changes, okay, or some calamity happens, or this pandemic which we are facing, it happened, then what will you do? For example, if you take automobile industry, okay, generally March, April are those months where we have many good occasions where many of us take new vehicles. So our automobile industry was ready to deliver the vehicles. Okay, many advance bookings were also done. Okay, many things were done, but what happened suddenly? The production was at peak, but because of this pandemic, situation completely changed. Okay, the products which were ready had no market, have no market, because currently the financial situation of each and every individual will be a bit low. He will spend money thinking twice, especially on luxury items. So now balancing becomes very difficult. Okay, so this ratio is very important because it is directly relating your profit with the sales. You are constructing an apartment, you have invested money. Out of 12 flats, 8-9 flats go easily, but 2 or 3 flats remain. What will you do? Okay, you have recovered your investment just, but all your profit is lying in those 2-3 flats which you have not sold. What you felt as the flow was good, I did not advertise, I did not reduce my cost, I did not compromise, and my flats will get easily sold. But suddenly one more building started to come up besides you. It was built by a reputed builder. He was offering more facilities at a competitive cost. All your clients get diverted there. Okay, you failed in studying the market. That's where this ratio becomes very, very important. So these all things come in forecasting. So if you go further deep in this subject, the scope is huge, and these all things can become seminar or project topics if you give lot of interest in it. And these things are numerical and are very nice, or say very interesting to go deep into it. Okay, so I have tried my best to deliver this lecture. If there are any fumbles here and there, okay, because for us also it's a new scenario, please try and understand. Secondly, write down these notes, because in your internal I might give you a balance sheet and an income statement as a question, and these ratios can be asked to be found. So at that time you should know the definition and which value to pick up from the balance sheet and income statement to find these ratios. So hopefully you are keeping up with your studies. Let's pray that we'll meet at the earliest in the classroom. Thank you one and all.